So the point that I was coming to is just like, we're talking about earlier going from 506B to C, right? That way you can have both class investors in there. But when you're structured at 506B, you can still have accredited and non-accredited both without any verification. As long as we stay at the non-credit limit of 35, the only difference is that we cannot advertise that.
Yeah, the two differences, you cannot advertise, and you're also allowed to reasonably rely on your investors' representation that they're accredited or not. So we usually give them, as you know, a questionnaire. They check the box and say, yes, I'm accredited, or no, I'm not accredited. You can rely on that. On a 506C, you cannot rely on a questionnaire. You have to take reasonable steps to verify, which usually means looking at tax returns or getting a CPA verification letter or looking at your 1099s, your W-2s, something that will verify their income or net worth requirements.
This is the Real Estate Vibe Show, and I'm your host, Vinky Loomba, a commercial real estate investor. And today, I have a very, very special guest, a celebrity guest, Mauricio rolled with me. Welcome, Mauricio, to the Real Estate Vibe Show.
Well, thanks for having me, Vinky. Really excited to speak with you today.
Awesome. So a little bit about Mauricio. He's a founder of Premium Law Group, and he's a premier syndication attorney in the country that helps real estate syndicators stay out of jail. I'm going to say that again one more time, stay out of jail. He's one of the few lawyers that speaks English, regularly traveling around the country, speaking to real estate syndicators about how the legal piece fits into overall syndication puzzle. He has shared stage with likes of Robert Kiyosaki, Ken McElroy, Brenda Turner, the host of Bigger Pockets podcast, and the Real Estate Guys. And today he's with us to talk about SEC compliance. So before we get started with SEC compliance, Mauricio, I would like to ask you if you can briefly share your background and tell us how did you become who you are today?
Yeah, well, thank you for that intro. So I've been doing this now for 24 years now. I know I look like I'm 12, but I've been doing this for a little while. And started my career like every other attorney dreams of at a large law firm. And I did a lot of securities work, but I did it on the litigation side. So I was helping, the American client, big brokerage houses like JP Morgan, American Express, Charles Schwab. And I was helping them once they got sued. So I didn't get involved into any cases until something actually went wrong. Which is not really a lot of fun because there's a lot of friction in those environments. And so what I do now is way more fun because we're actually on the front end of things as opposed to on the back end, and everybody's working together, which is what I love. But I just realized early on that was not for me. I didn't want to spend all my life at a law firm, and lucky for me, I came across one of the people you just mentioned there, Robert Kiyosaki. Came across his book Rich Dad Poor Dad, which I'm sure a lot of your audience has read, and that changed my way of thinking. It was very impactful to me. That actually led me, a long story there that we don't have time for, but that eventually led me to the Real Estate Guys. And I ultimately became their general counsel or their in-house counsel. So I was working with all of their syndications and drafting their PPMs and all that fun stuff. And then about, maybe 12 years ago now, I started my own firm, kept the Real Estate Guys as sort of my VIP clients, but then decided to start Premier Law Group, which I guess was more than that. It's almost, it's actually, now that I think about it, it was 2006, 2007 that I started Premier Law Group. And that's grown now to where it is today, where we really, when I started the firm, you do whatever puts food on the table, right? Whatever anybody wants you to do, you do it. Over the years, we've narrowed our expertise and we really focused on real estate syndications, which is what we do now. So my job is to make sure that, capital raisers, people who are taking money from passive investors, make sure that they do that in full compliance with not only the federal securities laws, the SEC, but also state securities laws. And I kind of jokingly say that I help clients stay out of jail, recognizing that jail is generally left for people who are really committing some intentional frauds and people defrauding their investors. And most of my clients are more likely to be non-compliant than fraudulently making fraudulent statements. So anyway, so that's how we are today. Now we're up to we have a team of about 14, 15 people. We're still a pretty small firm, but we've grown over the years, and we're just really excited to see where things are going to be going.
Wow, that's awesome. And the future looks pretty bright. 14, 15 people, and you're doing awesome work. So let's start with the bare basics today, to understand what exactly SEC is, Securities and Exchange Commission, and what is its role in the financial markets. If you can start from there for us.
Yeah, so as you said, the SEC is the Securities and Exchange Commission, and they regulate the purchase and sale of offers and sales of securities. And that always catches people by surprise because, in our world, as you know, Vinky, we're all real estate investors. So it's like, well, why is the SEC, who regulates securities, why are they involved in my business? I'm just buying a piece of property. I'm raising some money and I'm buying a single family, a duplex, a multifamily, whatever it is that you're buying. And the reason for this is because the laws define what a security is extremely broad. Most people think of securities as, stocks and bonds and mutual funds and those kind of financial instruments, which is correct. But the SEC defines it actually as much more than that. So anything, for example, like profit sharing agreements, tenants in common agreements, obviously, LLC units, corporate units, limited partnership units, essentially anytime you are raising money from passive investors where the returns are generated by your efforts, meaning you're doing all the work, and the investor is literally writing you a check and going home, that's going to be a security no matter how you set it up, no matter what you're buying. You could be buying real estate, you could be buying orange trees, you could be buying cryptocurrency. The structure itself doesn't matter. If you're taking money from passive investors and you're doing all the work, you're the one who's actually generating the return, then that's going to be a security. And that's what we do in our real estate syndication worlds. We have our clients like yourself, like a sponsor will actually go out into the marketplace, talk to passive investors, raise capital, but the investors are passive, right? They write a check, you do all the work. And because of that, you're considered a sponsor and you're considered somebody selling a security to those passive investors. And that security actually technically is that LLC unit. Most people use LLCs. So what they're doing is they're giving you $50,000 or $100,000. And in exchange for that, you're selling them 1% of the LLC, 2% of the LLC, whatever percentage, that's the actual security. So that's why the Securities and Exchange Commission is involved, because you are in the business of selling securities, at least according to the government.
So would you also please share some of the key regulations and requirements that's enforced by SEC?
Yeah, so once you understand that concept, once you understand that what you're doing is you're selling securities, then I like to say there's three things we need to be concerned about. One is we have to register that security or that syndication with the SEC, the Securities and Exchange Commission, or we have to find an exemption to registration, or number three, it's illegal. Those are your options. You got to register, find an exemption, and it's illegal. Now, we never register because that's going public. That's going to take you forever. It's going to cost you 7-8 figures. So in our world, we don't see anybody going public. Obviously, we don't want to do anything illegal or non-compliant. And so what I focus on and what all of my clients focus on is finding the right exemption to registration. And that's where these exemptions that you've probably heard of if you're in this world, like Reg D or Reg A or 506B or 506C or 504, all of these are just exemptions to registrations. And if you don't find an exemption and you just go out there and you just raise a bunch of money and not worry about these or maybe violate these exemptions, then you end up with an unregistered offering, meaning you didn't register your offering like you're supposed to, and you didn't have an exemption to fit in there. And so my world and our firm's world is spent 100% on trying to figure out what's the best exemption for your particular deal, and then making sure our clients not only understand the exemption, but also make sure that they're following all of the steps and all of the requirements of that particular exemption. And by far, the most popular exemptions are these, what we call these Rule 506 exemptions, 506B and 506C. These are two rules that are found within Regulation D, which is like the big exemption. So you have the rule, the federal rule, which is the Securities Act. Then Reg D is that exemption, and within Reg D you have a bunch of different rules. The most popular are 506B, 506C, and the reason these are the most popular is because a couple reasons. One is that they're safe harbors, meaning once our clients actually comply with the terms of these particular rules, we're assured of compliance. There's no guesswork. There's no relying on somebody's opinion as to whether we comply or not. Certainty is very important, and then maybe more importantly, or just important, these preempt state law. And preemption is just a fancy way of saying we don't have to worry about the states, because you can imagine if you're raising money from 6 or 7 different investors from 6 or 7 different states, Well, now you've got to make sure that you comply with, let's say you've got an investor in California and one in Texas, one in Florida. I've got to make sure that my offering complies with all those state statutes, right? So I've got to hire an attorney over there. I've got to spend time and money, and I've got the federal laws. I mean, it just becomes a nightmare to do that. And so this 506B, 506C basically says, look, I don't have to worry about the states. I mean, to an extent, I have some anti-fraud provisions I still have to comply with, but I don't have to worry to make sure that my offering is compliant with all these different states. As long as I'm compliant at the federal level, then I'm compliant at the state level, which is, again, one of the reasons why so many people use, and when I say so many, I'm talking 94, 95, maybe now it used to be 96. I think it's gone down a little bit just because there's another exemption that's becoming a little bit more popular. But the vast majority of exemptions are going to be 506B or 506Cs.
So since we're talking about 506B and Rule 506C, can we start looking into what is the difference between the two and how syndicators are using it towards their benefit more?
Yeah, I always tell clients that there's two pivot points that will dictate which way you want to go. One is going to be whether you intend to advertise your deal, because if you want to advertise your deal, you're kind of stuck with 506C, because 506C is the only one of those two that allows you to go out there and go on a podcast and talk about it, or go on a radio, put ads or Facebook ads, or talk about it on social media, whatever advertising you want to do. That's only 506C. So if you want to advertise, we're kind of going towards 506C in that case. The other pivot point is whether your investors are going to be accredited and non-accredited, because if you want to have non-accredited investors, which I'll define in a second, but if you've got some friends and family that you want to bring into your deal and they're non-accredited, well, now I'm forced to go into 506B because 506B allows me to take non-accredited versus the other one does not. And so those are really the two pivot points. And, most people end up in the 506B category. And again, just pulling from statistics that the SEC comes out it's about a 90 to 10 or 92 to 8 in that range breakdown. And the reason I think it is because, again, a lot of first-time syndicators, I just heard a stat that said that 70% of syndicators have less than 3 years of experience. So there's a lot of new syndicators out there, but syndicators tend to have, friends and family and, Uncle Bob and Aunt Jenny, and they tend to be non-accredited. And so they generally navigate towards the 506B, at least at the beginning. And then generally, once you kind of run out of those resources or your investors kind of are tapped out, then you might look into trying to advertise and get a wider audience. And that then tends to have people to go to a 506C. But 506B, you can raise an unlimited amount of money. You can take up to 35 non-accredited investors, as long as those investors are sophisticated, and you are prohibited from advertising or generally soliciting. So you generally have to have what's called a pre-existing substantive relationship with your investors in order to do a 506B. And then 506C is basically the exact same rules, unlimited, all the stuff is exactly the same, except for you're allowed to advertise, which is a nice thing. But the penalty for doing that, so to speak, the penalty for being able to advertise is that you must limit yourself to accredited investors only. And that's kind of the big limitation. And you've got to take reasonable steps to verify that they're accredited. I can't just take their word from him. So again, when a client reaches out or a potential client reaches out, I always ask them, do you plan on advertising? No, I don't really. I wasn't thinking about it. Great. So we can do either one. And then the big question then becomes, are you planning on taking any non-accredited investors? Because if they are, we really are limited to 506B if we're just doing it between those two. As I mentioned before, there are other options, Reg A, and some other intrastate, but those get a little bit more complicated. And there's a reason why 95% of people use one of these other two.
So you talk about the accredited and non-accredited investors. So what defines the accredited investor versus non-accredited investor?
So I'll give you the accredited investor definition as it stands today. It's actually a little bit in flux. And if somebody finds this episode 3 or 4 years from now, the definition, there's a good chance it will change. But as of right now, anyways, the middle of 2023, an accredited investor, so I'll tell you what an accredited investor is. It's somebody who has either $1 million in net worth, excluding their primary residence, so you can't count your primary house, or has earned $200,000 a year the last 2 years and a reasonable expectation of earning that much this year. So almost like $200,000 the last 3 years. And then if you're combining your income with your spouse, that has to be $300,000. They just recently added to that definition. And there's a couple of more people that are accredited that have nothing to do with their financial wherewithal. And those are people who have special securities licenses. So if you have a Series 7 or a Series 82, Series 65, you're a registered investment advisor, then you're also going to be considered accredited no matter what your financial status is. But there's a lot of bills that are right now literally in the middle of session that have passed the House and are waiting to pass the Senate, where those rules will be extended a little bit, and they're taught. And I think here in the next couple of years, you'll be in a world where even if you don't qualify under the financial wherewithal, you're going to have the option to go take an exam, just like you can get a securities license and get accredited that way. They're going to have certain tests that you're going to be able to go study for and show that you know a little bit about securities law or a lot about securities laws. And once you pass that test, get certified, you too can be an accredited investor irregardless of how much money you make. Because as you can imagine, there's been a debate for many, many years as to whether, people with money, that should even be a factor, because we all know people who are of very modest means and are the smartest people in the room, know more about securities laws than everybody combined. And we all know people who have a lot of money, and they're the dumbest people in the room. So there's always this debate as to whether money should be a factor. Clearly, somebody with money has the ability to lose it. So that's one of the reasons. But again, if somebody's sophisticated, everybody here is big boys and big girls. So I think there's a movement towards that test, which I anticipate happening here sooner rather than later.
Yeah, I read an article on that too. Actually, I was going to ask you about that. I'm glad you shared that. So other question I wanted to ask you is, these days I have seen the deals are being structured like 506B to 506C, right?
Yeah.
So you can raise from B and then you can eventually move to C. But I want to ask you a question here. Earlier you mentioned one good point, that you can have up to 35 non-accredited investors in your deal in the B. And after that, when you're done, if you have a room, you can bring in C. So how is that scenario different than structuring it as a B and then going to C?
Yeah, so this is a relatively new rule. This now has been in effect, I want to say just over 2 years, I think March of 2 years ago. And this is when the SEC basically overhauled the integration rules. Not that we don't want to get into the integration rules, but there's a concept where if you start doing two different offerings that are substantially similar, but you're trying to play fast and furious with the rules, the SEC would just come and say, look, you can't just start a syndication and have 35 non-accredited and say, oh crap, I need more. Let me just shut this one down and let me start a new one. And then the SEC will combine those. They'll just see that you're just trying to get around the rules. Well, when they updated the integration rules, they specifically allowed, or I don't say it's exemption, but the way they defined the integration rules, that they said they will not combine the two or will not integrate the two if you start a syndication under 506B, fully comply with 506B, and then essentially what you do is you terminate it's the same deal, but you terminate 506B, and then from that point forward, you start under a different exemption, like a 506C. It could technically be Reg A at that point, but you start with another exemption that does allow advertising, and then from that point forward, you go out and you advertise, and you fully comply with 506C. So you kind of create this proverbial Chinese wall, right? You start under 506B, comply fully, right? You can take a limited number of accredited investors, no advertising. You have a pre-existing relationship. You don't solicit outside. And then at some point you say, look, today we're going to terminate our offering technically, and you're going to start a new one. And this new one is going to be a 506C, but it happens to be for the exact same asset. It's the same building. It's substantially the same structure. The SEC will no longer integrate that. And so a lot of people I shouldn't say a lot. I actually thought more people were going to take advantage of it. But so some people have started to do that. They'll start it in the 506B. They'll get all their non-accredited in there. They'll fully comply. And then they'll start, once they do. There's some safeguards I like to do that I don't know if anybody else does these, but we like to, first of all, document that pivot point. So I like to put that in, not only in writing, but somehow to timestamp that so nobody could argue when you actually pivoted. So whether that's a notarized document, or maybe these days, maybe a DocuSign document that just maybe a resolution that very clearly says, you didn't manipulate the date moving forward. And then I like to create two separate classes of shares or membership units in the offering. That way, when I'm out there with the 506C part and I'm actually advertising on social media, it's very clear that I'm selling class B, for example, of the thing. So there's no confusion as to when I was selling class A, I was doing it under 506B. And now that I'm doing it under 506C, I'm selling a different class. Everything's the same voting rights, same distributions. But again, it just eliminates any potential accusations that I'm kind of blending those together, because you really have to be a very clean cut. I mean, when you terminate 506B, there's no more stragglers, right? No more, oh, I forgot a document to come in. Oh, I've got the wires on the way, or, oh, my IRA is taking its time. You'll get it tomorrow. No. 506B has to be done. And so one of the ways I make it very clear that these are two separate is by creating separate classes. But more and more people are starting to find out about it, and more people are, but it's certainly something we would discuss if it's relevant to your particular scenario.
So is there any cooling period going from B to C?
Nope. Nope. As long as it's a very clear delineation and no more documents are coming in, no more money's coming in, no more, you're not soliciting or advertising before that date. There's no cooling off period. It's literally you're terminating and starting a new one.
Okay. So let me ask you this question. When you're doing, it's a 50B structure, right? And you're allowed to have 35 non-accredited investors in there. So if we need more people, we can bring the accredited investors in that deal too, beyond that point? Or
yeah.
no?
So under a 506B, you can accept, I used to say, for our purposes, let's just say an unlimited amount of accredited investors. Mm-hmm. There is actually a limit, because once you get to 2,000, you have to actually go register and make it public, mm-hmm. but that's not going to happen. So from an accredited standpoint, you can bring in an unlimited amount of accredited investors. Mm-hmm. It's just the non-accredited investors that you have to be careful with, and you're limited to 35 non-accredited. So that's the rule, but you can bring in as many accredited as you want. So in fact, and by the way, sorry, in fact, a lot of people will actually do a 506B and only take accredited investors. Everybody assumes that 506B means you have non-accredited. No. 506B means you have generally pre-existing relationships, right? They're still the vast majority. I mean, all these huge financial institutions that you hear, like BlackRock and Goldman Sachs, when they go do a fund, they use 506B, but all their clients are accredited. They're institutional. They're usually, institutional investors, but they're still going to rely on 506B so that they can avoid this issue of verifying them, which a lot of these bigger players don't like.
So the point that I was coming to is just like, we're talking about earlier going from 506B to C, right? That way you can have both class investors in there. But when you're structured at 506B, you can still have accredited and non-accredited both without any verification. As long as we stay at the non-accredited limit of 35, the only difference is that we cannot advertise that.
Yeah, the two differences, you cannot advertise, and you're also allowed to reasonably rely on your investors' representation that they're accredited or not. So we usually give them, as you know, a questionnaire. They check the box and say, yes, I'm accredited, or no, I'm not accredited. You can rely on that. On a 506C, you cannot rely on a questionnaire. You have to take reasonable steps to verify, which usually means looking at tax returns or getting a CPA verification letter or looking at your 1099s, your W-2s, something that will verify their income or net worth requirements.
So, and earlier you mentioned Reg A. Let's talk about that too. What exactly is Reg A and how is different than Reg D?
Yeah, so Reg A is I like to say is you have your cake and eat it too, because you get to advertise your syndication and you get to take non-accredited investors. There's some limitations as to how much they can invest and everything, but every time I say that, and I kind of do it on purpose, and they're like, Mauricio, wait a minute, this is amazing. Like, why didn't you tell me about this Reg A in the first place? Well, the main limitation with the Reg A is that it really is what we call a mini registration. So unlike a Reg D, a 506B, 506C, we don't ask for anybody's permission. We just prepare our documentations and we go raise money. With a Reg A, you actually have to get approval from the SEC. So you have to submit you prepare your documentations, and before you give them to the investors, you have to give them to the SEC. They're going to review them. They're going to come back with comments and revisions. You're going to send them another draft. You're going to go back and forth with the SEC for a while. That usually takes about 6 to 9 months for that process to happen. So most investors who are buying a particular property, they don't have 6 to 9 months to wait for the SEC to approve their deal. They've got to close in 90, 100, 120 days. And so it's not very feasible for most people to do a Reg A if they're buying a particular property. Now, if you're doing a fund or a blind fund, really more of a blind fund where you don't actually have a particular property, you just want to raise the capital first, then you'll go look for a particular property. Well, now there's no rush. So if you want to wait 6 to 9 months or a year for your whole thing to happen, you have a little bit of that luxury to do that. But it is going to cost more money. It's typically a good 6 or 7x the cost, because again, you're going back and forth with attorneys at the SEC. So it's a lot more labor intensive on the attorney side. And then there's all the compliance that happens once you actually get your Reg A approved. There's going to be, audited financials. There's going to be entry reports, exit reports, quarterly reports, all kinds of reporting every year. So there's a compliance component to it, which again, for me, just means more money. So if you can get past all of that, and there's a limit, you can only raise up to 75 million, which is not a huge deal. But if you can get past all those obstacles and say, hey, I've got a fund, I'm going to raise $100 million. I'm going to go through the process. I'm going to spend the $100,000 it's going to take to set it all up. If you get to that point, now you're in a good place, because now I can advertise my deal just like I can at 506C, and I can take non-accredited investors. There's really no limits other than, again, going back to this, I said 2,000 before on the accredited. For non-accredited, it's 500 before I have to go public. But I can raise from an unlimited amount of non-accredited. There are limitations of how much they can invest. They can only invest 10% of their net worth or their income, whichever's highest. So there's going to be some limitation there. And again, most Reg A's tend to be, in our world anyway, small. It's because people want to put in $5,000 or $10,000. Grant Cardone made Reg A pretty well known because he's had such a huge social media presence. He's able to get all these people who are non-accredited want to invest with him. He can't advertise, but with Reg A, he can advertise social media. His people, his fans can invest, and they're literally investing $1,000, $2,000, $5,000, $10,000 a piece. But that is an option if you're doing a fund. It's not really an option if you're doing a project-specific deal.
So you can structure the fund as a Reg A, and plus it's more like a crowdfunding platform that people use, Reg A as well, right?
The crowdfunding, Reg A, you do it on your own. I mean, you can have your own website. I think what you're talking about is there's another, again, there's so many exemptions, right? It just depends on there's one called regulated crowdfunding, or CF. And that's more a sort of a traditional crowdfunding, because you have to go through a portal, or you have to go through an SEC broker, and they're the ones that are actually going to, crowd everything into their website. You can do a little bit of advertising in terms of pointing to the portal. And there's also a lot of restrictions on how much you can raise and all that stuff. But I know very few people, if anybody, doing really CFs quite yet, because again, the compliance cost is high, and you're limited to raising, I don't know what they're up to. It's adjusted for inflation every year, but let's just call it $1 million over a 12-month period. But Reg A is an option, especially if you have a fund. And I'm telling you that there's been a lot more funds that the clients have been wanting to do over the last 2 or 3 years. And as more and more funds happen, more and more options to do Reg A's.
Interesting. So earlier you were talking about the advertising, like especially for 506C, there's no limitations, right? I heard you can even, throw the flyers out of the plane. It's all good.
You still have to be careful about the anti-fraud provision. So that's probably the biggest thing. I still, when people advertise on social media, you want to kind of do a quick blurb, and you really want to get them off social media onto a landing page or something where you can put some more disclaimers on there. Because what you don't want to do is sort of have misleading information. Because if you post something and say, hey, this is a 20% IRR, well, where are all the disclosures that kind of counterbalance that? And it's very difficult to do on a social media post or to do anything. So usually what I recommend is very broad, what the deal is about, kind of so people get an idea. If you are going to put some estimated returns, you want to put a big range, send them to a landing page where we can now put a little bit more disclaimers. These are subject to you reviewing the PPM and all the other, a lot of risks involved and all those kind of disclaimers. But barring the anti-fraud provisions, you want to take an ad out in the Super Bowl, knock yourself out. You want to hire the Goodyear blimp to fly over your town. And, you can go on a podcast, social media, what have you. You could do that under 506C and Reg A once it's approved.
And how about 506B? Because I have seen a lot of people, when they meet somebody, maybe one time or just go to a conference, just exchange the card and they add them to the database. And you have this offering 506B, and all of a sudden you're seeing that in your inbox. And I'm like, oops, I don't even know this person is sending me 506B offering. So what is your take on that? And plus, a lot of people, they put it on social media too. Oh, I got the deal, I closed the deal,
That happens all the time. And that's probably one of the biggest cases in favor of not doing a 506B, is that too many people are really violating. It's very, very difficult sometimes to fall. I mean, 506B is meant to be a private offering between you and your friends and people and it happens to me all the time. I go to these conferences, as an attorney, to either speak and so I'm passing out business cards for business, and then a week later, I'll get an email from this person, never talk to them, don't know who they are, just like you mentioned, and they're offering me a deal. Mm-hmm. Clearly, they don't have a pre-existing substantive relationship with me. Clearly, I don't know them. Clearly, the only way we connected was through a public forum, which was this webinar, this seminar, this event. And so those people are all violating they're basically breaching 506B that prohibits advertising or generally solicitation. So what ends up happening with most of those sponsors that they end up with what we call an unregistered offering because they didn't register it. So then well, what's your exemption? Well, you can't do 506B. You better find another exemption. Otherwise, you have an unauthorized offering. So that's a big concern out there. People are playing fast and rule. It's getting harder and harder to raise capital. So people are not going through the proper steps because there is a process and procedure. So if you met that person, at that event, they're supposed to reach out to you, get on a phone call, get a questionnaire going, really interact with you and have a relationship with you so they can understand what your goals are. You can understand, what they're about. And after a while, okay, I know this person. I feel like I have a substantive relationship with this person. Then you can offer them a future deal. You still can't even offer them the current deal because the general rule is you must have a pre-existing substantive relationship. That's two components. Substantive relationship means you and I better get together for coffee, for lunch, for Zoom, questions, emails, all that stuff for a while. And then pre-existing means pre-existing the offer. So once your offering starts, it's impossible to have, if you don't already have a relationship with them, it's impossible to have a pre-existing relationship with that person. So you can only offer them a future deal once you comply with that substantive piece. It's pre-existing, substantive, two things.
Yeah, but that's for 506B. It's not applicable to 506C. 506C.
Correct. That's only for 506B. Yeah. So that's why I always encourage folks who, if you have a big audience or you have the ability to reach a lot of people, go the 506C route because then you don't have to worry about getting to know everyone, getting into these pre-existing relationships, getting to figure out because really what sponsors should be doing is talking to their potential investors and finding out whether they're sophisticated or not. Do they have the sufficient knowledge and expertise in business and financial matters so as to be able to determine the risks and the merits of my investment? That takes time. That's not something, check the box. Yeah, I know what I'm doing. You're going to have to talk to them, send them a questionnaire. What's your level of experience? What's your risk tolerance? Are you a cash flow investor? Are you appreciation? Are you long-term? Are you short-term? Like this takes time. And what the SEC is looking for is they're looking for that quality of interactions, that fostering of the interaction. That might take a week, a month, a year. There's no magic number. It just depends on that quality of the interactions. But not too many people are doing that. They're literally, to your point, meeting somebody either at a conference or maybe they become sort of fast friends on Facebook or LinkedIn, but they don't really know them. And then the next thing you know, they got their email address and they're sending them a prospectus. That's not going to be compliant with 506B.
Yeah, but that's very common, because when you meet somebody for 2 minutes, you feel like all of a sudden, oh God, they are in my friend circle. Let me go ahead and leverage that, and start sending them the deal, start sending a bunch of things. And I have also heard of this misconception, maybe, once they're in your database and you're sending them a bunch of email, like people have email drip system, 7 emails, 9 emails. Well, these are called all the touch points, but these are only called touch points if they reply back to your email, right? If they didn't reply, you're sending the emails. It's like a one-way traffic, right? It's not necessarily a substantial relationship like you're talking about.
Yeah, but even if they respond, there's no touch. There's, a lot of people think there's a 3-touch rule or a 10. There's none of that, right? So the question is, are you able to determine whether this person has the financial wherewithal or the sophistication level to invest in your deals? And have they figured out what type of deals and what your philosophy is? And going through that exercise, can you do that in email? Maybe, but it's certainly going to take a long time. And I think, look, the SEC has been very clear. They've given us some guidance as to what that looks like. And it does not, emails back and forth are one of 8 steps, for example. So there's 8 steps that the SEC is not looking for, but have said, hey, if you do these 8 steps, we're pretty comfortable that you're doing a good job and you're really fostering that relationship. But the main one is going to be giving them some kind of a questionnaire. So you at least get that preliminary background information on them of what their level of experience, what they're looking for. And then phone calls or coffee or lunch or Zoom calls, one-on-one telephone calls where you're grilling them and they're grilling you so that they can find out whether their interests are aligned. And that takes time. I mean, that's not something that you do with a couple of mass emails. In fact, there's an argument to be made that if you're just mass emailing someone, especially if you're trying to advertise to that person, that sounds like a general solicitation, even though it's a contained email. So you got to be super careful. I think that's one of the biggest arguments against using 506B. And by the way, I'm planning on doing a show on my podcast, like a little debate between 506B and 506C, because the folks that really want to do 506C, their best argument is most of the people doing 506B aren't doing it properly anyway. They don't have a pre-existing relationship with everybody on their list. Nobody's really going through all that stuff. So if they're not, then you're better off doing a 506C. Yes, there's some limitations, but at least you're not running afoul of the securities laws.
That's true. Oh my God, it was so insightful show. We are out of time, but I wanted to ask you one more question before we
Yes,
go. So
please.
I wanted to ask you, what are some of the potential consequences of non-compliance with SEC regulations? Because we talk about a bunch of rules, a bunch of regulations, what will happen if something goes wrong, if somebody figured out, somebody complained about you?
Yeah, let's assume that there's nothing intentional or malicious or fraudulent. Then what's going to happen is you basically you have an unregistered offering, and the penalty for that, or the remedy, is what we call restitution. So the investors have a right to get all of their money back plus interest. So the way I always say it is, like, if you're not doing a compliant offering, then you're essentially guaranteeing the investors their money, because even if it wasn't your fault and the market turned or whatever, if you're not complying and you violated securities laws, you're going to be obligated to return all the investors' money. So it's basically you're guaranteeing plus a return of interest. Now, what typically happens, of course, is when that happens, somebody's lost the property, and so they end up having to file for bankruptcy. So, but they're going to be restitution, penalties, and interest, a monetary thing, and then like I said, they're not going to have the money, so they're going to probably file for bankruptcy. So that's the main thing. And of course, if you're now fraudulently if you're running, if you're intentionally defrauding or you're commingling things, then obviously that could raise to criminal. Just ask Bernie Madoff. When you're intentionally ripping off your investors, it rises to the level of criminal malfeasance. Then it's not just money, you're looking at jail time potentially, which is why the title of my book, The 5 Things Every Syndicator Must Know to Stay Out of Jail.
I like that. I think it was really good. We're out of time. I definitely wanted to have you back because I have tons more questions. But before that, let me ask you one golden nugget for my audience at this.
Oh, one golden nugget. Put me on the spot here. Stay off of social media. I mean, even if you're doing especially if you're doing a 506B, which is almost the way the SEC looks at this, it's such a broad definition of what an offer is. I think you're playing with fire. So if you post about your cats, post about your kids, stay off of social media if you're doing a 506B until you're done and you're in between deals.
Oh, interesting. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You're going to answer in one word or one sentence only, spontaneously. So are you ready?
You're asking an attorney to answer in one word? I'll try. Let's do it. Let's try it.
Yeah, try that, right? So first question is, what is one important thing that you have learned in your life, and how did it change your life after learning it?
Scaling. For my personal, I was a one-man show back in the day. I got very, very sick about 5 or 6 years ago, and almost lost everything because of that, because I was just a one-man single point failure. And since then, I vowed that I would never let that happen again, which is why I built a team. So I think everybody should be building their own team to have sort of a self-sufficient business. If something were to happen to them, their world doesn't collapse.
Awesome. I like that. Scalability. A lot of people, they get scared when they hear the word scale or scaling. Yeah. Because they wanted to do everything themselves. And there's something called delegation that plays a big role when you're trying to scale. So question number 2 is, what is the best book that you have read and recommend to my audience? Not Rich Dad, Poor Dad, because everybody knows about that.
I would say Traction by Gino Wickman, talking about scaling. Then that's kind of goes back and forth, but that's the EOS system, the entrepreneurial operating system. Highly recommend Gino's book.
That's a good one. I have that one too. So that's the PDF version available too, if somebody wants to look into that. In one word, what does life mean to you?
Balance.
I like that. I'm Libra. I'm all about balance. What is your biggest passion?
My family.
Oh, nice. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Don't be a single point failure, because you're going to end up in the hospital for a couple of years, and you better be ready.
That's a good one. I like that. Thanks. So how can people reach out to you, Mauricio?
If you go to just askmauricio.com, that'll forward you to, and if you got any questions, and I'm all over social media. I spend a lot of time on LinkedIn and then also YouTube. I've got a YouTube channel. I've got over 200 videos, I think, at this point. It's just Mauricio Raoul. If you found any value in this, go check out the YouTube channel, subscribe, and get more of this content.
Thanks for being with me on my show today. I'll definitely have you back some other day now.
Sounds like a plan. Thank you for having me.